What's up guys, so welcome back to the channel. So in today's video I thought I'd go through how I actually trade gold. Due to the recent volatility on gold, there hasn't been really that many opportunities, but I thought I'd take this opportunity to show you how I personally trade gold, because gold is a bit of a weird pair. If you've ever tried to trade gold, you know that a lot of the times it will just come to certain areas and then immediately fly in the opposite direction, and it doesn't really give you enough time to enter if you're waiting for a confirmation. So in this video I'm going to go through how I get around that problem and actually enter on gold, sometimes without any confirmation, and I'm going to be breaking down that full strategy. So if that sounds interesting to you guys, stick around to the end of the video. Make sure to like, subscribe, and I will see you on the charts. Okay guys, so before we go through some examples on the actual TradingView chart, I just thought I'd go through on a Google Doc sheet and outline the full strategy that we're actually going to be using. So if we start from the beginning, the first thing that we want to do is, obviously as with any strategy, you want to highlight the overall direction and the overall trend. So that is just going to be our step one, which is to identify the higher time frame trend. And we also want to mark out any areas that we're interested in potentially buying or selling from. So these are our points of interest, or POIs. And underneath, we need to actually say what a point of interest is going to be. So there's a certain number of things that I look for when I look for my points of interest on gold. And these are basically the things I look out for. So we'll just label this the criteria for them. And what we need to see, an imbalanced area, an imbalanced area of supply or demand, which needs to also be in a premium or a discount of the current leg, and I'll show you what that exactly means in a minute. But if we just put that on, we also need to see, so we have imbalance, supply and demand, and we also need to have liquidity taken at the point of interest, because market moves based on liquidity. So we always want to make sure that we are entering when the majority of people are losing, which is when liquidity is taken. So that is step one of the strategy, quite a simple one. On to step two. This one is a bit more subjective and takes quite a lot of experience, which you'll just get from backtesting this strategy if you want to learn it. But this is basically when we go down to the lower time frames and look for our actual entries. So for now, we'll just say lower time frame confirmation entry, just to briefly outline it. And we also need some set criteria for this. So for this, what we want to see is, say our point of interest is on the 1 hour, then we would want to go down to the 5 and the 15 minute for our confirmation entry. If the point of interest is on the 4 hour, I would go down to the 1 hour and 30 minute time frame for the confirmation entry. So it depends on what time frame you use, but for the sake of this, we'll just keep it simple and say in general we want to go down to the lower time frames. So what we need to see is a lower time frame break of structure. We need to see imbalance created, and we need to see a clear supply or demand formed. Yep, so that's the confirmation entry. The other type of entry I would use is a reconfirmation entry, which is when we get a second break of structure after the initial one. So we can just label this as step 3, but it's not really an extra step. It's more sort of a combined step in step number 2. So for a reconfirmation entry, we need to see pretty much the same thing, but we want a further break of structure after the initial one. And we obviously have to have the imbalanced supply and demand in this case as well. So that is basically the outline of the strategy. At the moment, it probably sounds a bit abstract, but if we go through a few examples on the chart, it may become a little bit more clear. So I've highlighted a few perfect examples. Obviously, you're not always going to get perfect setups like this, but if we just, it just makes it easier to understand if I go through the perfect ones. So I've kind of cherry picked them. So starting off on the 4 hour, which is step 1, we highlight the higher time frame trend and any points of interest that I'd be interested in. So if we go back here, you can see that clearly we are in a 4 hour bearish trend. So if we mark out the swing highs and lows, so here's our break of structure, and then we also have a further break of structure just here, and currently the low of the current trend where price, you would consider price to turn bearish if it breaks, is this low right here. So if price manages to break below this area, we would no longer be looking for buys, and I'd probably be considering sells, you know, all the way back down to fill these inefficiencies. However, since the price is still maintaining its bullish structure, at this point we are only looking for buys, and price is actually coming into a very nice area. So if we go back to the criteria, so for our point of interest, we need imbalanced supply and demand, and we need liquidity taken. So if we zoom in on this, you can see that we have this 4 hour sell to buy candle, so it's an area of supply. We also have this remaining gap here, which is an imbalance. So this area right here would be a point of interest for me that I'd be looking at. We also have, if we go to the 1 hour, this sort of equal low liquidity just resting above, which is why I wouldn't have considered this area of demand here at the bottom of this big imbalance, just because of that liquidity immediately below. So on the 1 hour, it's actually a lot clearer to see. And you can see that it's this clear consolidation which caused a break of structure and left inefficiencies just below. So this is a very valid area for us to look at buy positions. So the next step, remember, is to go down to the lower time frames and look for any changes of trend. So if we go back here, so immediately after price tapped into our area, we got this little bit of a push up. We then had a further push down, breaking past this structure, making this point here the most recent structural point within the trend, so the most recent lower high in this case. And obviously we have had a closure above that major structure point, so we can label this as our change of character, which is simply just a break of structure in opposite direction to the trend. And the other thing that we look for in our points of interest after we've had that confirmation was, if you remember, clear supply and demand and an imbalance created. In this case, we have this imbalance here, and we obviously have this clear area of demand here. So simply all we do at this point is set the limit and have a stop loss below the low. With gold, you want to be a bit more lenient with your stop losses and have it a bit bigger than you would when as opposed to trading forex pairs, simply because gold is a lot more volatile and it does have a tendency to wick out early buyers or early sellers. So a lot of the times you may see price come below this area, wick you out, and then go in your intended direction. So just to stop that happening, we want stop loss with a little bit of room below this low. And in this case, I'd probably just be targeting the next area of demand, next area of supply, sorry, which is this one here. So yeah, that is the first example. Let's see if it plays out. Gold also likes to consolidate at your areas of interest, but that is just a good sign that it may want to reverse direction, because it often just accumulates orders like this and then eventually moves in one direction, usually with a lot of momentum as well, so you can catch some big moves using this strategy. So all we do now, since there are no setups at the moment, we would just wait for a further break of structure in either direction. So in this case, we have this being a break of structure. There we go. So price did also break structure once again. And now we can start from the beginning and start looking at points of interest once again. So now we've had this break of structure. This is clearly the trend low because it's the most recent higher low. So we've had higher low, higher high, higher low, higher high. Sorry, this would be the most recent higher low. So this whole, from this box to this high, that is our trading range, and we're only looking for areas of interest within that range, since if price breaks this low, we would consider the trend to have reversed, and then we'd be looking for sells. So at the moment, I can see one area that stands out for me, and it would be this area of imbalanced demand down here. If we look on the 4 hour as well, we do have this 4 hour sell to buy candle. So an area of demand on the 4 hour as well. This area here, we sort of approached the area of demand with this wick, but didn't quite reach it. So I would see this as inducement, which you can view as a form of liquidity. So this area of interest ticks all of our boxes. We have imbalance, we have a clear area of demand, and we have liquidity resting above. So all we would do now is simply wait for price to come into our level. Like so. We could also refine it to this 30-minute area here. And what I would normally do at this point, I would set an alert at the most recent structure point where I want to see price break. And this would obviously be our change of character since price would be breaking the most recent low high point of the trend. Let's see if price wants a break. We also need a closure above, by the way. A wick above is not good enough because it can normally just be a liquidity grab. There we go. So we have a clean closure above. And now as for areas where we can look to enter from, you remember we are looking for areas of inefficient demand with liquidity resting above. And in this case, this whole push up is now efficient because price retraced and filled in the imbalance. However, we do have an inefficient area of demand just here. If we zoom in on it, you can see that we did leave this small gap here. So that is a good indication that price may want to return to this level before then pushing up. After that trend change that we've had, because price has broken the most recent lower high and formed a higher low, clear indication that price wants to reverse from this downtrend and then continue up in the overall 4 hour uptrend. So this area down here ticks all of our boxes. We have imbalance, we have a clear area of demand, we have a liquidity, and so again at this point we simply set a limit. If this was a forex pair, I would probably just have the stop loss somewhere like here below the area of demand, but since this is gold, we would want the stop loss probably below this low because of the tendency to wick out early buyers like I mentioned. And then for this, I'd probably be targeting again the next area of supply, which is this candle here, or you could target the trend high as well. Since price is in a clear 4 hour uptrend, the likely thing to happen is that price takes this high and continues its uptrend. So yeah, let's see what this does. Price taps us in. Also note how we had another piece of liquidity generated before price actually tagged us in. So price retraced, came very close to our level, but didn't actually tap it with this wick here. So that is a good indication that your point of interest is going to hold is because price will often generate liquidity and induce it in this way. And then notice how it came back, took out this inducement, and then did actually tap into our area. And then it just flew to the upside. Let's see if it hits target. There we go. So I hope you guys find this video useful. That is how I personally trade gold. So again, before I end the video, we'll go through from start to finish. Number one is highlight the overall trend and any areas of interest. For our areas of interest, we want an imbalanced area of supply and demand with liquidity generated above or below. And step two, we go down to the lower time frames, ideally about 2 time frames lower, 2 or 3 time frames lower than the time frame we use to get our point of interest. And then on that time frame, we will look for changes in trend by looking at the most recent structure and waiting to see if that area of structure breaks. And then we look for imbalanced areas of supply and demand to enter from within that new trend that has just formed. And that's basically it. As for targets, we will go for the next area of supply and demand where price may react from, or if the trend is very clear, as it was in this case, we would target the trend high. And as such, you can get very high risk to reward ratio trades like this, since we are entering on the lower time frames and targeting the higher time frame areas. So once again, if you guys did enjoy this video, make sure to like, subscribe, and I will catch you in the next one.